Please take your seats. Okay, so then we continue our analysis of bonds table after the information we had on Monday with this seminar about different accounting systems, so differences between typical European accounting systems and the international accounting standards. It's more of say more advanced topic, but I thought that it would be interesting for users to be exposed to those kind of topics at this level, and also to understand there is labor market out there, okay, for those who like to specialize in accounting. So let me go back now to the liabilities that we were analyzing last week, namely the bonds payable. Remember, we introduced bonds payable on Friday, and we said that bonds payable are a special class of liabilities because they are securities. Okay, securities means they can be traded, they can be exchanged. So it is easier somehow for companies to raise finance if they issue bonds because they know that investors will be able to recover from their investments before maturity by selling this loan to someone else. Okay, so this is what security means. It means the right to collect this money, which is the promise the company makes, can be traded, can be sold, okay, to someone else. And we mentioned on Friday that some bonds are traded on financial markets, so there are official markets where those bonds are traded. That means that there is an official market where you can buy and sell those bonds. And we saw some prices. We saw, for instance, the London bond market, and we saw some of the prices there. Not all the bonds are traded. That means that you buy a bond which is not traded on the financial market. If you want to sell it, you need to find a buyer somehow, okay, which is not simple. So it's not very liquid as an asset. It's the same problem you face when you want to sell a house, okay, or a car. It's not like there is a market where you can go and you know what the price is, right? So, but most bonds are traded. The bond markets are the largest financial markets in the world. They're larger than the equity markets. Bonds are very common as investments in all kind of companies, especially banks, insurance companies. They hold large quantities of bonds, and let's say that 80–90% of their investments, 80%, okay, their investments are bonds, not equity investments. So on Friday we were explaining the details of issuing bonds. We said bonds can be issued at the par value, at the discount, or at the premium. Okay, remember this term, the par value. We're going to use it again when talking about shares. The par value is the face value. Okay, so it's the promise the company makes. So in this example you see here, the promise is 100,000. Okay, that's the promise that the company makes, which is the repayment that's going to be made at maturity. And this promise can be issued at the face value, at 1 million or 1,000 in this case. So there was actually an example in some of the previous slides. So this is when the bonds are issued at the face value. Okay, so you collect 100,000 and you have a liability of 100,000. Okay, so in this case, the coupon rate, that is the official rate which is printed on this security certificate, is equal to the market rate. Okay, so you're offering a bond at exactly the market rate, which is equal to the coupon rate. Whenever there are discounts instead, it means that the market rate is greater than the coupon rate. Okay, the coupon rate or stated rate is fixed, something which it's a promise. Okay, so it's printed on the certificate. So if you want to offer a higher rate, you need to lower your price. So bonds can be issued at a discount. Today we're going to calculate these discounts. We're going to learn how to calculate this discount, which is here 2,851, but we'll learn how to determine this amount here. So most importantly, what is the purpose of this discount? Well, the purpose is offering investors a higher rate. And now you could ask, well, why don't they just raise the interest rate? They cannot increase the interest rate because it's fixed. It's a promise, it is fixed. And as I say, very often, those instruments are designed months in advance. Okay, so they issue, let's see, December, January 2018, but the entire bond is been designed for months. So in the meantime, the market conditions can change. Okay, so it happens that sometimes you issue a bond after a few months after you have designed the contract, and it might require an adjustment in the yield, which is the return. Okay, this bond offers. It might require an adjustment in the yield, which is obtained by changing the price at which this bond is issued. So in this case, we generate a discount because we issued this bond below the face value. Remember, we collect less than the face value. This difference, which is shown in the debit side of this entry, it's a discount. Remember what we said about the nature of this item here. Essentially, this is additional interest, right? The company must pay. And this additional interest is considered a contra liability. Okay, so that's the nature, okay, we use for this account. In fact, we are going to report the bond minus the discount. Okay, so in the balance sheet, you're going to see the value of the bond as the net value, as the difference between the face value, which is 100,000, and the discount. Okay, so this is the present value of the bond at the end of the year. Okay, so at the end of the year, or in this case, the issuance, okay, which is the same. At issuance, this is the present value of the bond. And then, as time passes, remember what happens? The discount gets amortized. Okay, so it decreases, and by decreasing, it generates interest expenses. Okay, so remember this connection. So the reason why we have a discount is because we offer higher interest rates. Okay. However, this additional interest expense is not paid all at once. I mean, it is paid all at once. It's not recognized, okay, all at once when it's paid or at the beginning of the life of this bond. Instead, it is going to be spread over the life of the bond. Okay, so this is the mechanism. So I'm just summarizing what we saw on Friday, so let me know if you need some further explanations. What is the entry by which we amortize this discount? It's not an amortization in the strict sense, in the sense that we use for intangible assets. It's an interest expense. Okay, so we credit the discount, we decrease the value of the discount, and we debit more interest expenses. So eventually, the amount of interest expenses is greater than what you pay. You can see here from this entry, the payment is fixed. Okay, so the cash outflow is fixed. It's a promise, right? 9% over 100,000. The interest expense depends on the discount. Okay, so you can see in this case, we amortize using the straight line method. So we simply divide by 5, okay, the discounts, and we recognize 1/5 of this discount every year, or 1/10 over every semester, such as in this case. And you recognize this portion of the discount as an additional interest expense. So on top of the 4,500, you're going to recognize a portion of interest expense that appears in your income statement, so that the effective rate you pay on this bond is not 9%. Okay? It's actually 10%, which is the yield that you offer to your investors. So, summarizing, discounts are additional interest expenses. And instead of recognizing them as we pay them, because the payment appears only once at the end of the life of the bond, at maturity, we recognize those additional interest expenses over the entire life of the bond. Okay, as usual is our way of dealing with income statement items. We don't look at the payment, we try to determine the performance, the profit or loss of the period using the matching principle, and we're going to recognize the expense as time passes. On the contrary, premiums are exactly the, let's say, the opposite. Okay, so premiums is when you issue this bond at the value which is greater than the face value. Okay. There's a question, yes, please.
These interest expenses, which part of the expenses of the income statement?
Financial expenses. Okay, so interest expenses are part of your financial expenses. So financial expense is more generic terms. You could include also discount expenses for it. So remember, when you discount a note, okay, you get a financial expense, which is the discount. In this case, you have a financial expense, which is an interest. So below the EBIT, to be clear. Okay, so it's not part of your operating expenses. It's part of your financing expenses. Therefore, it's not included in the operating income, right? It's part of your net income, of course, but not of your operating income. Because it's related on how the operations are financed. Bonds can be issued at a premium, as I will say, that is above the face value. The reason is the conditions we offer are so good, so attractive, that many investors want to buy these bonds, so we can afford to issue this at a price which is greater than the face value, because this happens when with the interest rate we offer, which is fixed, okay, so the coupon rate is greater than the market rate. And when this happens, you can issue a bond at a premium. Now, the example is the following: the same bond, 100,000, 9%, 5 years. This time, the market rate is 80%, so it is less than what the bond offers. So this bond is going to be issued at a premium. We're going to calculate. Okay. The assumption is that the price at which this bond is issued is 104.10. Remember, prices always use 100 as the basis. Okay, so it means that you pay 104%, okay, of this the face value if you want to buy this bond. And with the amount of money the company collects is clearly greater than the face value of the bond. Okay, so remember that these discounts and premiums affect the amount of money the company collects. The bonds payable is always reported at the face value, and the difference is adjusted in this credit account here, premium on bonds payable. Now, what is this premium? It's part of this liability. It's an additional component of this liability. In fact, it's considered an adjunct liability. They must be seen in conjunction, the same way we see the discount in conjunction with the bond payable. But this time, instead of decreasing the value, we are increasing the value of the bond, so that the bond will be reported at 104,100. Okay, so that will be the value at which the bond appears in the balance sheet. Now, premiums get amortized too. Okay, although the effect is the opposite of what we have seen for discounts. The amortization of premiums generates lower interest expenses rather than additional interest expenses. payments are always the same. Okay, so the periodic payments are always the same. The final payment we're going to see today is always the same. Okay, so the promise is 100,000. Okay, so that's the payment. What changes is the expenses, the interest expenses, which are going to be calculated according to the discount or bond, of the discount or the premium we recognize. In fact, when we actually pay the interest every 6 months, okay, so the payments remains 4,500. There's no difference. Okay, it doesn't matter whether you have a discount or a premium. The difference is the amount of the interest expense, which is going to be this time less than the amount you pay. See, so the amount of interest expense is decreased by the premium. Once again, we divide the premium by 5 years or by 10 semesters in this case. Okay, so we recognize 1/10 of the premium. We debit the premium, and by doing so, we decrease the interest expense for the period. Right, so look at the entry. So there is a payment. Part of this payment actually is cancelled by this decrease in the premium. So the interest expense will be just the difference. Okay, so you can see how the interest expense, which we actually report then in the income statement, will be less than what we pay. After all, we collected more, okay, at the beginning, so now we are recognizing a lower interest expense. Eventually, the interest expense should be 8% of your debt instead of 9%. Okay, that's the idea. So you report those liabilities at the effective interest rate. Now, this is what we saw on Friday. Today we're going to practice in this because I'm going to explain how to calculate premiums and discounts, and then we're going to practice a little bit on those bonds, on issuing those bonds. The amortization, so-called amortization, okay, often in this case can be misleading. It's not like we amortize and we generate expenses. On the contrary, we amortize this premium and we lower the expenses. Okay, so the effect is the opposite of what you have with the discounts. So the amortization will be 410 per semester, okay, because it's a 5-year bond that pays an interest every 6 months, every semester. So this premium is going to decrease as time passes, and the carrying amount means the balance, okay, of the bond at the end of the year. The carrying amount is going to decrease. Okay, so eventually it starts from 104,000, then it decreases and decreases. Eventually it will reach 100,000, okay, at maturity. The same way, when bonds are issued at a discount, we increase the value of the bond up to 100,000. Okay, so in both cases, at the maturity date, the bond will be carried at its face value, 100,000 in this example. Okay, because in case of discounts decreases and the value of the bond increases. In case of premiums, the premium decreases and the value of the bond decreases. Okay, so as you can see from this example here. Now let me show you an example for retiring. For instance, I'm still looking at those financial statements that we have been using for a few weeks now. This is Campari once again. And Campari issued a bond in 2020 very conveniently, so it's rather handy because we get all the details here. Okay, so this is reported. Come on. Okay, so on October the 6th, 2020, okay, and let me zoom in. So they issued a 7-year Eurobond because it's in euros, okay? But then you can also issue bonds in other currencies if you want. Okay, you can issue bonds in dollars, but then of course you have to repay it in dollars. So you are going to add a currency risk, okay, to this transaction. So the face value was 550 million, and it was targeted at institutional investors. That means that the minimum size probably is something that normal individuals cannot afford. Okay, it's not like 1,000. Okay, it could be maybe the individual size would be 200,000, 500,000 euros. Okay, so this is the minimum lot you can buy. So only institutional investors means pension funds, banks, insurance companies, investment funds. Okay, those are institutional investors. It pays a fixed annual coupon of 1.25%, so it's a plain vanilla bond, meaning that it simply pays a fixed interest and nothing fancy, no other characteristics, okay? 7 years. The issue was 99.76%, so with a small discount. Okay, so this was issued with a small discount, so that it does say here, but later it says the effective rate is a little bit higher than 1.25, clearly. If you issue at a discount, the market rate is higher, not that much, because there is a small discount. You can see here the difference is rather small. And anyway, it's an excellent rate, because you can issue at 99.75. A bond that pays 1.25, it means that your actual rate is going to be what? 1.5, 1.6, not that much, okay, if you think about the cost of financing. So it's a signal that this company is considered very reliable, very solvent by investor. Low risk, okay, so it's a low risk investment, so the yield is low for the investors. They have other bonds. Okay, but this was just issued in 2020. They have older bonds issued in the past, so this was issued recently. So this is an example of how companies actually frequently use this form of financing for financing their operations. And also, I didn't mention this, but there are now we have also something called green bonds. They become fashionable. Green bonds are exactly as other bonds. They have no different, but they finance normally environmentally friendly projects. Okay, so they're supposed to finance projects that will help fighting climate change. Okay, that's the idea. So it's a way of saying investors, look, if you want to put your money in something that improves, okay, or is supposed to improve the environment, you can give us your money, and we're going to spend it for those projects. Okay, so it's very fashionable right now to to be green. In fact, there is also the risk of greenwashing. That means appearing green while not really doing what you're supposed to do. But it is very important for companies right now to appear green and also socially responsible. Okay, so we also talk about social bonds. Okay, so bonds that are used to finance projects that will have an impact on society at large. Okay, it's very common. In fact, the green bonds are actually sort of certified. Okay, so there is a label. Let's say this is a green bond. The bond is identical to other bonds. It's not like they have different financial characteristics. Okay, the only difference is the purpose. Okay, in this case, comparative doesn't say why they're asking for 550 million for their needs, for their investments. They don't specify. So this is not a green bond. Okay, they say we need this money because we want to, improve the efficiency of our production process in order to reduce pollution. Okay, that would be labeled as a green bond. In this case, just a plain old bond without any specific characteristics. Okay, what about retiring bonds payable? Retiring means payment. Okay, so transactions to retire bonds payable. Why don't they say just payments? Because sometimes bonds can be retired before their maturity. Okay, sometimes it happens. Typically, this happens whenever there is a feature which is explicitly stated in the bond contract. You cannot just retire a bond at will. It means that when this bond was issued, it contained this feature that allowed the issuer to retire the bond before maturity. But sometimes the company realizes that it is better to repay the bond before maturity instead of continuing to pay interest, especially when the interest is rather high related to the current market conditions. So if you issue a bond at 7% and then after 5 years the interest rates drop, you might reissue the same bond at, let's say, 5%. Okay, so you could retire the old bond and issue a new one. In order to do this, you need an agreement with the investors. So the investors must know that the company can retire the bond before maturity. Okay, so it's something that must be stated by the company. It's not like they can retire any bond, okay, at will. So typically retirement happens at the maturity date. Okay, when this happens, the company pays the face value. Okay, so this is the promise, right? So the face value is the payment promise which is made. So let's look at the entry, which is very simple actually, when the retirement happens at maturity. Okay, so assuming that all the interests have been paid and all the discounts or premiums are fully amortized, okay, the only entry which is necessary is the repayment of the principal, the face value, okay, which is the principal. So we debit the bond payable that now gets a zero balance, okay, thanks to this entry, and we credit cash by the face value. That's it. Okay. What about the interest? Interest is being paid periodically every semester. Okay, so I assume that we have made already those 10 interest payments, 4,500 per semester, okay, for 5 years. What's left is the principal, 100,000, which is going to be paid with this entry. Okay, so it's a simple repayment of a liability, as you can see. And this is when the repayment happens at maturity. Okay, the maturity which was written on the contract when the bond was issued. If the bond is retired before maturity, there are some calculations to perform. They're not terribly relevant, but just keep in mind that there are some bonds that have those features. That means they can be retired before maturity. Those are called callable bonds. They can be called. Okay, to call means to call back, to buy back a bond. So bonds can be called before their maturity. And those are called callable bonds. It's important you know this because if you invest in a bond and you want to keep this money there for, they say, 10 years, and then you need to know that there is a chance that after 3 years, the company is going to retire this bond, and then you need to find another investment for your money. Other bonds can have some extension features. Okay, those are typically reserved to large investors because they're risky. That means some bonds, especially those issued by banks and insurance companies, sometimes have their terms extended whenever some financial distress happens to the issuer. So the risk is higher because the investor knows that in case of financial distress, the terms are going to be extended instead of shortened. Okay, so there's also a feature. Some bonds are perpetual. There's no maturity. Okay, so they promise to pay 5% per year forever. Okay, and then they of course have the opportunity to retire them when they feel it is necessary. So there are many different bonds out there with different characteristics. Some, and especially some bonds, pay a variable interest instead of a fixed interest. Okay, and this can be linked to a variety of factors. Could be interest market rate that fluctuates. Could be price of oil. Could be inflation in the U.S. market. It could be the price of stock. Okay, so there are different bonds out there. They have different purposes. There are bonds related to weather, for instance. Okay, so they don't pay an interest in case of tornadoes. Okay, so there are all kinds of bonds out there. We're just looking at the most basic format, which is the plain vanilla bond. Okay, but there are also catastrophe bonds, weather bonds, and so on. So if the bonds are retired before maturity and those bonds are callable, okay, it means that they may be paid off before maturity. And typically, we need to calculate what the value is at maturity. So it's not terribly relevant for us, but it will introduce us to the interest calculations which are necessary to determine discounts and the premiums. This is an example. The company has issued this bond. The remaining balance is the discount balance is 3,081. The company can buy this bond on the market. I mean, a company can buy its own bonds, right? How is it possible? Well, clearly, when the issuer buys its own bonds, it's actually refunding the bondholders in practice. Okay, so sometimes companies buy their own bonds on the market just to refund the bondholders. Some other times, instead, they simply refund the face value to the bondholders. In this case, since the price is 95, which is much less than the face value, would be a good idea to repurchase this bond on the market, assuming that you find the sellers, assuming that the sellers want to sell, because you're not forced to sell. I mean, if you want to keep it, you can say, no, I want my 100,000 at maturity, so you're not going to sell it. Okay, but if you can buy the entire bonds on the market, remember, you don't have one investor, one bondholder. There are possibly hundreds or even thousands in some cases of bondholders. Okay, so it's like you can just need to convince one of the bondholders. But if you can convince them all, you can repurchase this bond on the market at 95. In this case, you can even make a gain, right? Because the difference between what you should pay and what you actually pay could generate a gain. That's an example of what can happen. However, my focus will be for not on this, but on the discounts and the premiums. Okay, so I would like to make sure you understand what they are and how they are calculated. So this will require us to revise some of the notions we have about interest calculation and present value calculations, namely, because we're going to use them now to calculate the discounts and the premiums. So let me skip to the relevant part of my presentation. So we're going to use the whiteboard mostly. And just a second, I need to skip to another part of the presentation. So just a second. Okay. So using the time value line to compute present value and future value, which is something we introduced already. Remember, we already introduced the interest calculations. Now we're going to apply those interest calculations to bonds. What is the only difference? Well, instead of calculating the interest over one period, okay, we have 1 year, 1 semester. We are going to have long-term financial instruments that require multiple calculations. Sure, rather they can be rather long. That's the only, let's say, drawback. But the concepts are exactly the same that we have already introduced. So, just to remind you what we should know already, that we have this called the time value of money, which is used to determine the present value of a bond, that is its price. Okay, so how do they know what the discount is, what the premium is? Okay, it's a present value calculation, essentially. So considering that the payments are fixed, okay, if you calculate the present value of those future payments at the market rate, you get the current price of the bond, essentially. That's the trick. So you need to identify the cash flows, which is the payments, okay, generated by the bond, and you need to calculate the present value of all those payments using the interest rate that derives from the market interest rate. Okay, not the coupon rate, because otherwise you get 100. Okay, so you get exactly the face value. The key here is using a rate which is different from the coupon rate. If you do that, you realize that the present value you calculate is different from the face value of the bond. Let me show you an example which is easier. It is easier with an example. First of all, some concepts. Some of these will be known, some others are new. For instance, the principal is the amount of investment with the face value, right? It can be paid as a lump sum, so one-shot payment, or as an annuity. An annuity is a periodic payment of the same amount every period, okay, every year or every semester. So you need to know what the principal is. You need to know the number of periods, so the length of time, and you need to know, of course, the interest rate, okay, that we're going to apply in order to calculate the interest on a sum. Now, when talking about bonds, the present value is calculated using the compound interest method. Okay, remember the distinction, the simple interest method, the compound interest method. Okay. Using the compound interest method, the assumption is that we calculate interest on interest. Okay, that's the assumption we have. Let me show you an example that will help us understand the present value of the bond. I'm looking for an example I can use, and then I can calculate this with. Well, we can use this precisely this example we have here, 100,000, right? 100,000 at 10%, okay, for 5 years. Okay, so let me show you my whiteboard here, and let's see what the characteristics of the bonds or the bond are. The characteristics are the following: the face value, is 100,000. The coupon rate or stated rate is 9%, and the time, okay, this period will be 5 years. Okay, and also remember this bond pays an interest every 6 months. That will be important. Okay, so we have those semi-annual payments of interest. Now let's start by identifying the future payments that are originated by this bond. Okay, so essentially this bond generates a payment of 4,500 per semester, as we saw this, right? Because 9% over 100,000 for 6 months. Okay, for 6 months, so divided by 2. And then eventually it generates an outflow of money of 100,000. Okay, those are the future payments originated by these financial instruments. So you have a series of outflows, okay, of cash. So let's count this semester. Okay, 1, 2, 3, and 10. Okay, so we have minus 4,500. Okay, forget about the amounts. We have the payments of 4,500. Forget about this. Minus can be confusing. So the payments are 4,500 per semester for 10 semesters. Okay, so eventually you get to the final payment at maturity. And at maturity, you also have the principal. Okay, so this is the future payments generated by this bond. This bond generates 4,500 per semester, so 10 payments. Okay, and it generates a final payment of 100,000 on the at maturity. Okay, so at the 10th semester, essentially. So there are 10 payments, okay, or 11 if you count if you separate the final payment between principal and interest. Now, if you calculate the present value of this bond at 9%, you get 100,000. You know, I can prove this, but it would be long. Okay, so we can calculate the present value of this at 9%. Actually, not at 9%, but at 4.5%, which is the rate we apply to each semester. Okay, so half the yearly rate. So if you calculate the present value, you find 100,000. So the formula would be the following. So the present value, which is 100,000 in our assumption, would be equal to 4,500 divided by 1 plus 4.5% for the first year, first semester, plus 4,500 divided by 1 plus 4.5% to the power of 2 for the second semester, 1 plus 4.5%. Okay, of course, this is the percent to the power of 3, and so on until we get to the final payment, which is 104,500 divided by 1 plus 4.5% to the power of 10. Okay, so if you calculate the present value at the coupon rate, the present value is going to be 100,000. Okay, by definition, essentially. So if the coupon rate is 4.5% per semester, okay, you calculate what is the present value of those future 10 payments at 4.5% using the compound interest method, you get exactly 100,000 by definition. Okay. What if the market rate is not the same as the coupon rate? What if the market rate is greater than the coupon rate? Well, in this case, it means we know that we have a discount. Remember, we said if the market rate is greater than the coupon rate, there is a discount. But why? Well, if we calculate the present value at the market rate instead of the discount rate, we only change the denominator. We don't change the numerators of these formulas here. So the flows, the cash flows, the payments are the same. What changes is the interest rate. 10% market rate versus 9% coupon rate. Remember, that was the example that we saw in the slides. 10% per year, which means 5% per semester. Okay, so if you repeat this calculation at 5%, well, you're going to get a value which is less than 100,000. Why? Because you're increasing the denominator and you're not changing the numerator, so the result of this calculation must be less than 100,000, right? So that's why you have a discount, okay, because it means that the present value will be less than the face value. Okay, so if you repeat this calculation with at 5%, so the present value will be equal to 4,500 divided by 1 plus 5%, first payment, plus 4,500 divided by 1 plus 5% to the power of 2, plus, etc. 104,500 divided by 1 plus 5% to the power of 10. Okay, you get this present value, which is a number will be less than 100,000. Okay, you can tell, you can know for sure it's going to be less than 100,000. It's not difficult to calculate. It's long because it's boring, because you need to calculate 10 or 11. It depends on what you want to do. They say 10 present values. Okay, and also you know a scientific calculator, because you need to calculate the power of 4, 5, 6, 7, 8, 9, 10. So you cannot do this with your normal calculator. You need a scientific calculator or a computer, of course. Okay. So this is the idea behind these discount calculations. Okay, so if you change the interest rate, then you change the present value, and the present value is what the company is going to get when this bond is issued. And the difference between the amount you promise to repay, which is 100,000, and the amount money you collect will be the discount in this example. Okay. Please note that 5% is half of 10%. Okay, so it's 5% would be the rate for one semester. Okay, 10% would be for 1 year, and 5% for this semester. Okay, this is why we use 5% instead of 10%. Because if you use 10%, you would actually apply a 20% rate per year. Okay, because the payments are made every semester. Okay, so it depends on when the payments are made. If you make just payments every year, then you can use 9%. Okay, if you want to make payments every semester, you need to use half the rate. So we can calculate this. Also, it's going to be long. That's the only drawback. That's why there is a shortcut for this calculation that will make our life easier, because instead of performing 10 different present values calculations, you just need 2 calculations. One for the interest, for the series of interest payments, which are always the same, 4,500 per semester, and one for the principal, 100,000. Okay, so you can solve this with just 2 present value calculations, as we see in a moment. This shortcut works. I cannot explain why, okay, but it works. So I'm not in a position of demonstrating that this shortcut actually derives from this, but you're going to study this in the future. So my colleagues are going to explain this to you. I'm not professor of financial mathematics, but I know how to use it. Okay, so this is what matters for me in this moment. So I can use those shortcuts in order to perform these calculations more efficiently. So let me show you this, and then we'll have a break. Let me show you what we mean by the calculations. Okay, so just a second. Okay, so this is the example we're going to calculate after the break. Okay, so we have maturity payment 100,000, periodic payment 4,500. Okay, the actual interest rate is 10% or 5% per semester, and the number of payments is 10. Okay, twice payments, twice a year for 5 years. Okay, this is all the information we need, because the coupon rate is 9%. The market rate instead is 10%. Okay, so this is the idea. And we're going to calculate this present value we see after the break. We are separating the present value of the maturity payment, which is 100,000, okay, and the present value of this series of payments of 4,500 per semester, which are all equal. Okay, so this is called an annuity in financial calculations. An annuity is a series of payments by the same amount every period, in this case every semester. Okay, so you have an annuity of 10 payments of 4,500 for 10 semesters. Okay, that's the annuity. And given this series of payments all equal, okay, you can you can use a shortcut, a more compact formula to calculate in one shot the present value, not of one single payment, but of an annuity of payments. Okay, so the entire time series of payments, which of course saves a lot of time because instead of performing 10 calculations, okay, you only need once. Once again, I'm not going to explain why it works, but I can assure it works. Okay, so it does work. So we'll apply this after the break. All right. So I'll see you in 10 minutes. Okay, so let's proceed with the calculations now. Let's start from the easier part, which is the present value of the final payment of 100,000. Right, that's easy, right? Because you know you're going to calculate the present value of 100,000 at 5% for 10 periods. Okay, so here this information, this all information we need for calculating the present value of the principal. And then we're going to calculate later in a moment, not later, in a few seconds. We're going to calculate instead the present value of the periodic payments. And in order to calculate this present value, those 10 payments of 4,500, instead of calculating 10 times, okay, the same. So reporting 10 times 10 calculation, we're going to use a compact formula. So let's start with this part. You can ignore the second part, focus on the first part. Okay, so let's focus on this part here. That's the present value of the principal, okay, which is simply 100,000 divided by 1 plus 5% to the power of 10, compound interest. Okay, so we calculate this for 10 periods. So 100,000, 10 semesters from today at 5%, the present value will be 61,391. Okay, that's the first part of the problem. The first part is calculating the present value of the principal, right? Is it clear? Remember, this is the present value calculations according to the compound interest method, which is the only method we use when performing those financial calculations, when we move sums in time. Okay, we calculate the present value of future sums or future value of present amounts. We use the compound interest method. What about the interest instead? The payments, the periodic payments. You see this weird formula here, then I'm going to generalize this. But this weird formula is a shortcut that summarizes 10 calculations of present value, 10 present value calculations. So you need to know what the payment is, 4,500. You need to know what the interest rate is, and you need to know the number of payments, 10. Okay, so this is the present value of 10 payments of 4,500 every semester at 5% per semester. Okay, so this is the formula, right? So it's the present value of an annuity, technically. Okay, so in financial mathematics, this would be explained as the present value of an annuity. And if you apply this formula, now I'm going to generalize so you can remember if you want this formula. You are welcome to calculate 10 present values if you want. Okay, it is the same, just a matter of saying some time. And if you put together the present value of the principal and the present value of the interest payments, you get the present value of the bond, right? So the present value of the bond is equal to the present value of all the future payments, principal and the interest. 96,139. The face value is 100,000. What is the difference? It's 3,800 or something, which is exactly what the textbook reported as the discount on the bond payment. Okay, so that's where the discount comes from. It comes from the difference between the face value, 100,000, and the present value calculated at 10% per year, or 5% per semester. Okay, so that's what the discount is. We know there is a discount, and we knew this already because we know that whenever the market rate is greater than the stated rate, the coupon rate, you must have a discount because the present value must be less than the face value, less than 100,000. Okay, so if you calculate the present value, we saw this in our formulas earlier. Where was it? It was here, right? So if you calculate the present value, this is what we're doing in what we did actually, also in using a different formula. 4,500, 1 plus 5%. 4,500 divided by 1 plus 5% to the power of 2 and so on. You get 96,000, the amount you saw on the slide. Okay, so that's because we use 5% instead of 4.5%. So if you increase the denominator, the present value will be less than the face value. Okay, so if the market rate is greater than the coupon rate, the present value is less than 100,000, less than the face value. The opposite happens with premiums, of course. Okay, so if you lower the interest rate, then the present value is more than 100,000. Now, let me explain this shortcut that I have employed here. Okay, so this part here, where does this come from? It's here. Okay, that's the present value of an annuity. So, where R is the payment, in our case, 4,500. Okay, I is the interest rate, 5%, and N is the number of payments, 10 payments. Okay, so this is that will save us time, because instead of calculating those 10 present values, you just calculate once. Okay, clearly you need to calculate the power of 10. Okay, and so you still need a scientific calculator to do that, but it is actually faster than calculating the present value of each single interest payment, which it is still doable if you want. Okay, but if you have 20 payments or 30 payments, it becomes very long process, especially if you do this by hand. You can automate this with computer, but by hand is going to take a while. So that's where the formula comes from. Okay, once again, it's a shortcut we can use. It's an optional shortcut. If you don't trust me, the calculation, okay, so you try, and you can apply the formulas and see that you get exactly the same amount. Okay, so this here in this case is 5 payments of 2,000 at 6%. Okay, so you can perform those 5 present value calculations. Okay, or you can use the compact formula. You get the same result. Okay, so the present value will be always the same. You can try this, okay, and see that the results are the same. So this way you can easily calculate the present value of the bond. Okay, remember this is just for the interest part. Then you need to add the principal. Okay. Because just to specify this, because also there was a question during the break, the final payment is composed of principal and interest. Okay, the final payment, which is the last payment, includes the last interest payment and the principal of 100,000. Clearly, it's a good idea to separate them for us, because even if the last payment happens on the same day, the interest payment can be calculated with the annuity, and the principal can be calculated by itself as the present value. So you can calculate the present value of the principal by itself. You can see here. Okay, that would be the present value of the principal, and then you calculate the present value of the annuity, considering that the last payment is equal to 104,500. Okay, that would be the final payment that includes the principal and the interest. Okay, we separate the principal from the interest because this way it is easier to calculate the present value. So if the present value is 96,139, what is the discount? Well, it is the difference, right? It is the difference between the face value and the present value, and right, the face value and the present value. So the discount would be equal to 100,000 minus 96,139. Just a second. Okay. That's 3,861. Okay, that's the discount. Okay, so if you know this, you can journalize these issues because you know that you're going to collect 96,139 in exchange of the liability of 100,000, and the difference will be a discount in the debit side. Okay, so that's what will provide the information we need in order to journalize the issues of this bond. And then we'll practice, okay, later. What is this clear? Can I continue with the premium? Don't forget the meaning of premiums and discounts. Okay, so discounts whenever the interest rate is greater than the stated rate, so the market rate is greater than the stated rate, so you have a higher interest expense. The premium is the opposite. Okay, so the market rate is less than the coupon or stated rate, so your interest expense will be lower. So premium, let's issue this bond at 8% instead of 9%. Okay, so or 10%. Once again, the payments are fixed, 4,500 every semester, 100,000 at maturity. There's no difference here. The only difference is the market rate, which is now 8% per year, which is 4% per semester. Okay, so the only change is the interest rate. So you realize that if you decrease the interest rate, your present value is going to increase because the interest rate is reported at the denominator, okay, of this formula. So if you decrease it, the present value increases. In fact, let's apply the same formulas to this premium, okay, to this bond, sorry, and we will realize you get a premium because, first of all, we have the present value of the principal, 100,000 divided by 1 plus 4% to the power of 10. Okay, this is the present value of those 100,000 at 4% per semester. And then let's apply the formula, the present value formula to the annuity of interest, which is always the same. So look at the payments, 100,000, 4,500. They're always the same. They don't change. Okay, what changes? The only variable that changes here. Also, the periods are the same. The only variable that changes is the interest rate. It's the only difference. But if you change the interest rate, you get a different present value. In this case, it's going to be 104,055, and so you have a premium. Okay, so you have a premium, which is clearly the difference between 100,000. Sorry, the present value. So the present value minus the face value. Face value or principal. Okay, in our example, it's clear that the premium is going to be 4,055. Okay, so now we know how the premium is calculated. We can journalize the entry. The company is going to collect $104,055 of cash. Okay, that's the cash amount. The liability, the bond payable is going to be worth 100,000. Difference would be the premium. Okay, so that's how those entries are done. So that's how the amounts are calculated. Those are present value calculations. Okay. We'll, as promised on Wednesday, we'll practice. So we're going to perform these calculations on an example and to review what we know about bonds in the last leg of today's session. Okay, so from 5 to 6, we're going to perform these calculations and to practice on journalizing bonds. bonds. As you see, there are many factors at play when you talk about bonds in terms of interest calculations, in terms also of the nature of bonds. Let's not forget the big picture. Okay, so those are long-term forms of financing. They are tradable, so they can be exchanged, and they have fixed conditions. Okay, so this is why we have premiums and discounts. We have premiums and discounts because the interest rate we pay is fixed. It's going to be always the same. Okay, 4,500, it doesn't change. So if you remember this fact here, you realize why we changed the price of this bond when we issued. Okay, so why does Campari issue at 99.7% instead of 100? Well, because they all need to offer a slightly higher return to the investors. They cannot increase the payments because those are fixed. So the only way they can do that is that they cannot by offering the investors a discount. Okay, so if they offer them a discount, their return increases, and the expense increases also for the issue. Is it clear? Now, we'll practice later, but now let me highlight some issues that we have introduced already, but that probably that are going to keep us busy for our next classes, which is this difference between issuing bonds and issuing shares. Remember, we saw an example, but it is now time to talk about shares more in detail, or about the equity more in detail. Now we know what liabilities are. We know that liabilities generate an interest expense. Okay, now this interest expense is not always equal to the payments we make. We know that in case of premiums and discounts, the interest expense is not the same as the payments, and we know that liabilities must be paid. Okay, so obligations must be paid. Those are financial debt that must be paid back. What if instead we have equity financing, and what if we have shares, and what are they? Because also shares are another class of financial instruments. There are two main classes of financial instruments: debt instruments such as bonds, and equity instruments. Okay, so as an investor, okay, you can decide whether to invest in the equity of a corporation or in the debt of a corporation. Okay. And of course, as a company, you can issue debt instruments or equity instruments. Okay. Clearly, as we mentioned already, investing in the equity of a company is much riskier than investing in the debt of a company. Okay, so if your risk profile is of a low tolerance, okay, to risk, you don't want to invest in the equity of companies. You better invest in bonds. They're not without risk, of course. Okay, so there's always the risk of not getting your money back, because we saw that sometimes companies can be insolvent. So companies sometimes they can default on their obligations. Okay, but yet at least you have a right you can enforce. You have a legal right you can enforce. Okay, so you can bring a debtor to court if they don't pay. Okay. In case of equity investments, instead, you're not investing in the liabilities, in the debt of the company. You're investing in the equity as one of the owners, right? As one of the owners, you don't have the right to get your money back. You do have other rights, however, but you don't have the right to get your money back. And moreover, the whole investment can be lost. If something, goes wrong in this investment, if this company doesn't, for instance, declares bankruptcy, you're going to lose your investment, which is bad news. The good news is you only lose your investment. You don't lose more than what you have invested, which is an especially powerful benefit you get, because it's not always like that. I mean, if you start your own business as the only owner, remember the restaurant we mentioned to start weeks ago, and things don't go as expected, you risk your own wealth. You're risking your car, your house, okay, so your own property, right? Because you're going to be responsible for all the obligations made by the business, right? This is why no wealthy individual will ever be the only owner of an enterprise, because the risk is too high, okay? That's why corporations were invented, right? So that you can invest in this corporation, you are going to put at stake only a portion of your wealth, not your entire personal wealth, okay? Just a portion of it. And your liability is limited, meaning that if the company does not have money to pay its debt, that's it. It's not your fault. I mean, you're not going to lose your wealth, your personal wealth, because the corporation has no means. So corporations can default, can be declared insolvent, and this is not going to have consequences on the owners of the corporation, which is a huge advantage, and it also allows people to invest in risky enterprises. This is the main distinction. So for the point of view of the issuer, of course, raising debt means they have to pay the money back plus interest. They have this fixed payment they must make. Okay, those 4,500 every 6 months. And remember, we saw an example of this Chinese corporation that failed to pay the interest in time, and they just made it maybe 1 month later. Okay, so it was on the verge of being declared insolvent, right? So those obligations are fixed. It means you need to have the money, the necessary liquid assets, cash, to meet those payments every 6 months, for instance, in this example. If you issue equity, you don't have the same pressure on your cash, because you don't have to pay anything, say, periodically. However, the investors do expect something in return. Okay, they expect either an increase in the market price, so you need to do well. Your company must perform, and possibly better than the competitors. And they also expect a periodic payment of dividends, which, unlike the interest you see here, is not fixed. It is not the same amount every year. Okay, it depends on your profits. So it could be higher in good years and lower in bad years. Yes, they do expect something. Okay, so it's not completely free. On the contrary, the cost of the equity, which is not the cost in the accounting sense, because in the accounting sense you don't find the cost of the equity in the income statement. The cost of the equity is somehow higher than the cost of debt, because investing in the equity is more risky than investing in debt. So you want a higher return. So we saw Campari, for instance. Okay, so the cost of debt is 1.5%. Okay, this would be the return you get if you invest in the liabilities of Campari. But if you invest in the equity, you want more, because you're risking more. So you don't want you're not satisfied with 1.5%. You want more. Okay, so Campari knows that in order to keep their shareholders happy, they need to make sure that the return on the equity is greater than 1.5%, because otherwise they will just invest in the debt, or they not at all, because they don't have reason to run a higher risk for the same return they get with investing in the debt, okay, in the bonds of the company. So, what is the difference between bonds and shares? Well, shares are certificates, so I'm going to show you one share, and you can have a closer look during the break. Okay. So, well, it's banded. This is a stock certificate. It has no value. Okay, so it's just I bought this in an antique shop, so it's not really it has no value. The company does not exist anymore. So this certificate shows the ownership of a portion of the equity in a corporation. Okay. Now, as this certificate gets traded, okay, you can trade this paper, okay? By trading this paper, you also exchange the ownership in this corporation. Now, here it says that this certificate represents 100 shares of a par value of $1. This is a US corporation, okay? So this represents $100 of equity in a corporation, which is a portion, a percentage of the corporation. That depends on how many shares there are, okay? So if there are 1,000 shares, that's going to be 10% of the equity. The percentage is important because the percentage of the equity measures your power, okay, as an investor. If you have, let's say, 0.0001% of a company, you don't really have any influence at all, right, on the corporation. If you have 20%, 30%, 60%, okay, then of course you're becoming a powerful investor, even the investor that can control the corporation. You can control a corporation if you own enough of these. Okay, so if you get more than 50%, you control the corporation. What does it mean? You have the right to appoint the directors, the board of directors, those that actually manage the corporation. And since you are the majority shareholder, you can appoint the people you want. Okay, so people that you know are going to be loyal to you. They're going to make the decisions that you want they make. Otherwise, you can kick them out. You are the majority shareholder, right? So you can appoint other people there. So by controlling a corporation means that you acquire the majority of the shares. Now, maybe if you heard the news yesterday, there was this news that this American investment fund wants to buy the Italian telecommunication company, TIM, and they are offering a price for the shares, okay, which is a very good price because it's higher than the current market value. Okay, so if you're one of these shareholders, you have this investment, and someone is saying, look, I'm going to pay you more than the current price is. What do? Well, it's a very tempting offer, so you're willing to sell this certificate. Now they are not material anymore, they're not printed out anymore, okay? Now they are collector's items, but in the past they were always printed. You can sell this certificate to this new investor, and this investor is trying to collect enough stock to become the majority shareholder. What happens when this new investor, this investment fund, becomes the majority shareholder? They can kick out the current management, they can hire new management, the board of directors will be renewed at their conditions, and this new management is going to, of course, to take the management decisions they favor. Okay? So remember, it's not the shareholders that control the corporation directly. Okay, the shareholders are the owners of the corporation. They appoint the directors. Clearly, if you have a very small firm, very small company with 2 or 3 shareholders, family business, okay, with 2 or 3 owners, they are also going to be the managers, okay, the directors, typically, of the company. Large companies, such as TIM, for instance, okay, they're going to have shareholders which are separate from the directors, from the management. Okay, so management and control is separated. So what we are currently reading on the news is an attempt of a takeover. Takeover when it's a change of ownership, okay, of a corporation. So they have the money and they want to spend this money in acquiring the majority of the shares. Because the difference between bonds and shares is that shares will give you the right to vote. Bonds don't give you this right, okay? And the most important vote that the shareholders make is appointing the directors. They also vote for other matters. They don't vote for the day-to-day management of the business. Okay, it's not like they need to vote for, you know, should we hire this person? Should we sell this product? Those are management decisions which are made by the directors. They don't need the approval of the shareholders. But there are some decisions that must be approved by the shareholders. And especially the directors themselves are appointed by the shareholders. So the voting right is a very important feature of the of shares. We'll also learn that not all shares are equal. Not all shares have the same voting right. Okay, so there are shares with limited rights out there. And also, it will be important to understand that the shares issued are not always necessarily the shares that you that are outstanding out there, okay, on the market. So we're going to introduce some in the following classes some main aspects of the equity, which is the section of the balance sheet that we haven't studied in detail yet. First of all, the main characteristics of corporation, we introduced already, so it's just going to be we're going to summarize, okay, recap the main characteristics of corporations. And then we're going to journalize the issuance of stock. What happens when these certificates are printed out and issued, okay, to the market. We'll learn about something called treasury stock. Sometimes companies buy their own stock, buybacks. Okay, this is another common transaction you have in corporations. And we need to account for dividends. Okay. So we'll learn what cash dividends and stock dividends are. Okay, so those are fairly complex topics because there is a lot of interconnection with company laws. So it's in between accounting and company law. So you need how corporations work in order to understand the accounting for these topics. And we also need to understand that even shares have a par value, a face value. Okay, the face value of shares, unlike bonds, in which the face value is the amount of money you get, the face value of shares is purely conventional. It serves the purpose of determining the ownership, the percentage of ownership in a corporation. Okay, so if I know that there are 1,000 shares, so €1 each, and I have 100 shares of €1 each, I have 10%. Okay, so that's it. That's the end of it. What is the value of those 100 shares? Well, that depends. Depends how well or badly this company is performing. Okay, so there are cases where the market price is a multiple of the value, the par value of the shares. Simply because there are perspectives of profitability in the future, okay, in this sense. The first reminder, because something we have already seen, the reminder is what are the features, what are the main characteristics of a corporation. Remember that corporations are legal entities, okay, artificial legal persons with rights and obligations. We sometimes say companies, corporations, it is the same. Okay, so the same concept. It means that those businesses are incorporated. Okay, so they are registered as a corporation with rights and obligations, and they have some specific characteristics. For instance, besides being legally separated from the owners, okay, so the owners are not the same as the corporation, the shareholders are not the same as the business, which is not the case if you don't incorporate your business. Okay? If you start a business on your own, without incorporating this business, there's no legal separation between you and your business. It is the same. From the point of view of the law, to the eyes of the law, it is the same. So the obligations you take in the business are your obligations. Okay, so if you open a shop and you don't incorporate this business, it means that any obligation you take is going to be your obligation. Okay, so if you don't pay, they can take your assets. Okay, so that's the risk you run. Instead, in case of corporations, there is this legal separation, and the shareholders they're not personally liable for the obligations of the business. Okay, so there is of course typically more than one owner. Okay, and the owners are not personally liable, meaning that they do not have to face the company's obligations with their own means. So the obligation are met by the corporation. The corporation has its own assets, right? That's why we have a balance sheet, right? And the corporation faces its obligation with its own assets, not with the assets of the shareholders. There's lack of mutual agency, meaning that one owner cannot engage in transactions that bind the corporation. Okay, so if I buy shares of Apple, I'm one of the shareholders, right? Although I'm going to own just a tiny, tiny fraction of the equity, but I am one of the owners. I cannot go out there and say, look, I'm one of the shareholders of Apple, let's sign a contract on behalf of Apple. I don't have this power, because I'm not one of the directors. Okay, so I cannot involve the corporation in my dealings because I don't have this authority, right? The life of the corporation is normally longer than the life of its founders. Okay, so it's indefinite, and there's also a benefit because clearly they can go beyond the life, the physical life of the founders. There are characteristics of taxation. The corporations are taxed, they pay their own taxes. Okay, so essentially there is a risk of double taxation because you, as one of the owners, you're going to get a dividend, right? Which is out of the profits on which the company has already paid the income tax. And then this dividend is going to be an income for you, and you pay income tax. Okay, so there is a risk of double taxation. There are normally some, let's say, rules that try to minimize this risk. Okay, so typically you pay lower taxes on dividends rather than other forms of income. So whenever people say we should tax capital more, you should capital gain or dividends more, you should understand that this money comes from a corporation that already paid their taxes. So you're just taxing the same money again. Okay, so this is the reason why the tax rate of dividends is not the same as on other sources of income, because of the issue with double taxation. Okay, so those are the main characteristics, and the capital accumulation means that corporations can raise more money rather than the individual businesses. Okay, so we saw, for instance, the size of bond issuances that were made in the past. Okay, billions and billions of bonds issued. Clearly, this is not something an individual business can never dream to achieve. Okay, the size can be very large. Okay, this is another characteristic of corporations. When corporations raise money for the first time on the market, this is called an initial public offering, IPO. Okay, initial public offering is when corporations raise money for the first time on the market. Because corporations can be private, so you can have 4 or 5 shareholders and that's it, or they can be public, meaning that the ownership can be open to the public, and so their shares are listed on the financial markets. Okay. Example, when companies are founded, they're always private. You start a company, you are the owner, and you and a few partners, and you are the owners, so it's a private corporation. If you decide to get listed, it becomes public. Okay. An example was, of course, Facebook, for instance. It was founded by Zuckerberg and other partners, and it remained private until 2010, I believe, and then they went public. They made an initial public offering on the market, and it became a public corporation, okay, on which, of course, the founder, Zuckerberg, still has the majority of the shares. Okay, you don't need more than 50%. you need the greater amount. Okay, so if you have 20% and all the others have 1%, you control the corporation. So this is what we mean by by corporations and why also they are important. Some of the characteristics of corporations, advantages and disadvantages. Now, this is relative. I mean, for instance, a corporation can raise more money than a sole ownership, but also the ownership and management are often separated. I don't know whether it's an advantage or a disadvantage, depending on your point of view. Clearly, if you're one of the majority investors, because even large companies have a majority investor, especially in places like Italy, where those big companies we know of, they were born as family businesses, okay, initially. And the founding family is still behind those businesses. Okay, think about the Benetton or Agnelli, okay, so those founding families are still there, and they still have a relevant stake in the business. Okay, so we can't really claim that the ownership is separate from control. I mean, they still control the companies they own. Because if you have the majority of the shares, you still can run the business by appointing for instance, your family members as directors. Okay, so this is what happens very often. There are some companies which are true public companies, which there's no founding, let's say, entrepreneur, and where the ownership is really just public. There are very few of them in Italy. There are many others elsewhere. I think that in Italy maybe we have Generali, which is the insurance company. Okay, this is a public company, or Enel, the energy company. Okay, those are not really family businesses. Okay, so and they were not born as family businesses. So the ownership is spread over thousands and thousands of investors. Also, there are majority investors there. Then we have the corporation as a continuous life, which is not limited by the physical life of the founders. Also, the succession is a problem. When the old founders retire, the new generation that takes place is not always a smooth transition, not always simple. It is easy, that's the most important point, to transfer the ownership. You just transfer this. Okay, you transfer this certificate and you transfer the ownership. It's easy. Much easier than selling an apartment, because it's much easier than that. We mentioned the mutual agency, the limited liability. The disadvantages, of course, are that the earnings may be subject to double taxation. The regulation is expensive. And well, you heard something about regulation on Monday, right? We heard about auditing and committees, and the guests said that they spent like 500 million just on auditing and checks. So it is expensive, because whenever you become accountable, okay, which means responsible, okay, for your activities, the regulation becomes more and more expensive. And of course, listed companies have the highest amount of regulation, and financial reporting is expensive, and auditing is expensive, and so on. The startup costs are higher than just opening your own individual business. Okay, clearly, you have startup costs which are higher. Although there are incentives for young entrepreneurs or for innovative companies. So currently, for instance, there are incentives. For instance, you can start a company with €1, okay, formally, or 10,000, which is not that much if you think about it. Okay, so there are incentives for smaller corporations, for startups, okay, that can be started with a lower cost. So more about this on Thursday, tomorrow. So tomorrow I'm going to explain a little bit better how this works. Now instead we're going back to the bonds. Okay, so we're going to practice a little bit on bonds calculation and journal entries. And during the break, you can have a look at this. Just leave it here, please. Don't take it away. Just leave it here, and you can have a closer look at this. And we continue after the break. All right, let's continue with the last slide on today's session. Before we continue, there is a question from one of the students attending online. How do you know whether, when you start a business, whether you should incorporate your business or instead just proceed with an individual business, okay, sole proprietorship? Well, it depends, of course, on your needs. It depends on the resources you have, right? So, for instance, if you just start a business because maybe, I don't know, you like doing something with your hands, you like, you make vases you can sell online, okay, they probably don't need a corporation for that. Okay? But then if you have an idea and you need partners and you need to pool your resources with other people to start a business, maybe that's a very good idea to incorporate the business in order to limit your risks. Okay, so that's the point. The key here is limiting your exposure to risk. You don't want to expose yourself to unlimited liability. Okay, so if the business is a little bit more complex than working from home, okay, or selling stuff from home, then it's a good idea to incorporate the business just to protect your own assets from creditors. But more on this tomorrow when we continue our discussion about the equity and shares, and we'll learn more about shares. Now let's go back to the bonds table. You see here this exercise here. That, by the way, is one of those that I put online on Moodle. And this is the issuance of a bond. Please take note of the characteristics of the bond. Okay, so 1 million, 6%, 5 years. Okay, those are the characteristics. And issued on October the 1st. So this time we're going to worry about the matching principle. Okay, so adjustments at the end of the year. So October the 1st is the issuance date. And this bond pays once a year. Okay, so instead of every semester, so that we make our calculations easier, actually. So payments are made once a year. So the bond offers 6%. That's the stated rate. The market asks 7%. Okay. So can you tell me, is there going to be a premium or a discount? Discount, right? Good. So we're going to calculate the present value of this bond at 7%, which is going to be less than 1 million. Okay, so there's going to be a discount. The question is, why is there a discount? Because the current market rates, given the market conditions, given the specific conditions of this issuer, specific risk, okay, of this issuer, the market conditions currently are at 7%. So the investors ask 7% for this kind of investment. Okay. So once again, why don't we just offer them 7%? Because we cannot, because this bond has fixed characteristics. Okay, so the payments are fixed. So the only variable we can change is the price, the issuing price. So we need to answer these questions. In order to answer some of these questions, we have to calculate the present value of this bond. Let's start from the first question. What is the maturity value of the bond? Now, this is somehow tricky because very often when I ask this, students try to calculate the present value plus interest. Okay, but in case of bonds, the maturity value is the same as the face value. So it's actually a very, very easy question to answer. The maturity value is the value we pay at maturity, which is 1 million. Okay, so that's the easy part of the exercise. So 1 million would be the maturity value, also known as the face value, okay, of the bond. It is the same concept. So the first question, the answer to the first question is 1 million. Okay, so you don't have to do any calculation at all. No, you don't have to worry about. Some people calculate 1 million multiplied by 1 plus 6% to the power of 5. That's wrong. Okay, so you simply record here the face value. That's the maturity value of the bond. what is the carrying amount at the end of December? Well, this is a trickier question. Okay, much trickier because we need to calculate the present value of the bond at issuance, and then we need to calculate the present value of the bond at the end of the year. So this is going to require much more calculations. And we can do that. We can perform these calculations now. So the first step will be observing that we issued this bond on October the 1st. Okay, so this is the date. And we are asked to report the carrying amount, which is the amount at which it appears in the balance sheet at the end of 2020. Okay, so after 3 months. And so the first step would be, let's calculate the value at which this bond is issued. We know there's going to be a discount. Okay, we don't know by how much, but we know there's going to be a discount. And once we calculate this, we can also determine the value at the end of the year, because there's going to be an adjustment at the end of the year. Okay, an adjustment related to the payment we're going to make, and also related to the amortization of the discount. So let's proceed with the calculations then. Okay, so let me use my whiteboard, and I need the blank page. Here we go. Essentially, we can report the payments that this bond generates, right? So we said this bond has a face value 1 million, and it pays 6% coupon rate, 6% per year. Okay, so clearly this bond is going to generate in a different. So we can calculate the payments as follows. The coupon rate is 6%. Okay, the face value is 1 million. Okay, and we have 5 years. Right? Because those are the main characteristics. So, what is the interest payment we make every year? So the fixed, I highlight the fact that it is fixed. Okay, so the fixed interest payment will be essentially 6% of 1 million. Okay, that's the payment we make every year. Remember, the market rate is 7%. This has no consequence whatsoever on the interest payments. Okay, the payments are fixed. So it's 6% of 1 million. Okay, that is 60,000 per year, right? Am I right? Okay, so every year we pay 60,000. That's the payment we make. Right? So essentially, we have 5 payments of 60,000 and 1 payment of 1 million. This is the characteristic of this bond. So we have a total. Since we pay once a year, okay, not every semester this time. So we don't have 10 payments. We have only 5 payments. 5 payments of 60,000 per year, right? So what is the present value? Okay, so let's apply the formula. Let's start with the present value of the interest payments. So this is more than 1, 5 actually, plus the present value of the principal. Okay, this is total present value of the bond will be the present value of the payments of interest plus the present value of the principal. Let's start with the interest. So the present value of the interest payments, which is an annuity of 60,000 per year for 5 years. This is equal to, according to the formula we applied earlier, I'm going to rewrite the formula here. It's equal to the payment. Okay, so the payment multiplied by 1 minus, then I need lots of room here, 1 divided by 1 plus I to the power of time, this or number of payments, which is 5, divided by I, which is the interest rate. Okay, so I is the interest rate, T is time, right? So in this case, 5 years. Okay, so just to remind you what I'm doing here, I'm applying this formula here. Let me okay, so let me explain. Oh, come on. Let me show you what the formula is. Okay, PowerPoint just crashed, so that's a second. Where is it? All right, so this is the formula, okay? So I just memorized this formula. If you don't like to memorize this formula, no problem. You calculate 5 present values, okay? So 60,000 divided by 1 plus 7% plus 60,000 divided by 1 plus 7% square and so on, 5 times, okay? Or you can apply this compact formula. Okay, so R is the payment, 60,000. I is the interest rate, the market rate, not the coupon rate. Because if you apply the coupon rate, you get 1 million, okay, as the present value. So there's no point in recalculating the face value. And N or T is the time, 5, in this case, yearly payments, in our example, 5 payments, okay? So, where is my board? Not this one. This is the old one, right? So what's going on? Okay, this one, sorry. This is equal to 60,000, and we know that the payment is equal to 60,000, multiplied by 1 minus 1 divided by 1 plus, let me highlight this clearly, 1 plus 7%, the market rate. Okay, and you divide this by 7%. Okay, now, of course, it means 0.07, right, when you translate this into your calculations. The power of 5. Okay, can you read this? This S is a 5, like this is a 5. Okay, it's not S. So we can calculate this, and we can determine the present value of this series of payments, right? You're also welcome to calculate the present value of each single payment of 60,000 for 5 years. Okay, so you can do that if you want. You don't have to learn this formula. So let me try. So we start from 1 divided by 1.07 to the power of 5, 1 minus this, divided by 0.07 times 60,000. I'm doing the math, and I invite you to do the same because I don't guarantee that I don't make any mistakes. So it should be 246,012. Okay, this is my result. I don't know whether it's the same for you. Is it? Okay. Of course, I'm going to round it up, okay, so it will be 11.8, we can discard the cents, okay, so for the moment, we don't worry about cents now. So this is the present value of 5 payments of 60,000 per year at 7%. Okay, that's the first part. And then we need to calculate the present value of the principal. So, which is going to be easier because the principal is 1 million. Okay, so what is the value of 1 million 5 years from today at 7%? Okay, that's the present value. Okay, so it's simply the present value of 1 million at 7% 5 years from today. Okay, so divided by 1 plus 7% to the power of 5. So it should be 712,986. Okay, so what is the present value of the bond? It's the present value of the interest plus principal, right? So we had 246,000 and let me check. 246,012. Okay, so it looks like the present value is going to be 958,998. So clearly less than 1 million. Okay, so as we knew that, right, but we did not know how much less. Okay, so it's less than 1 million. So now we can calculate the discount, right, which is simply the difference. It's the face value minus the present value. PV is the present value, okay? Okay. It's 41,002. Okay, that's the discount. Okay, and now we have information which is necessary to journalize the issuance of this bond, and then you can also calculate the present value at the end of the year because this discount is going to be amortized over 5 years. Okay, so we divide by 5, you get the yearly expense, okay, the expense because of the amortization of the discount. Let's proceed with order. Let's start with the issuance. Okay, so on October the 1st, 2020, the company issues this bond. And it is important to realize that we need to debit cash by the amount we collect, which is the present value of the bond. While the bond payable will be 1 million. Okay, so the amount of cash is 958,998, and the bond payable will be 1 million. So clearly the difference here is 41,002. In the debit side, that's the discount. Okay, that's how we journalize this. And extra careful, the discount is not an expense. It looks like an expense, okay, but it is not an expense. It is contract liability loss. Okay, an increase in the contract liability, so it actually decreases the liability, right? It's going to become an expense eventually, but not today, not on October the 1st. Okay, it's going to become an expense over 5 years. How? Well, the assumption is straight line amortization. Okay, so which is and actually it is a simplification of what happens in reality, but it is good enough for our purposes. So straight line amortization of the discount over 5 years. Okay, so this is how you journalize the issuance. Okay, so the entry, I don't think the entry itself is terribly complex. Just remember, you get the present value in terms of money. Okay, so you debit cash by the present value, right? And the value of the bond is not 958, it's 1 million. So the difference is reported as a discount on the debit side. I think the most difficult part is understanding what this discount is. Okay, what the nature is. Okay, so it is a contra liability because it is an adjustment to the bond. What is the present value of the bond after all? Well, if you use present value accounting, this is future value accounting. Okay, but if you use present value accounting, the bond will be recorded at 958,000. Instead, it's reported at 1 million. What is the difference? Interest. Okay, however, we don't recognize this interest expense on October the 1st because it is a 5-year bond. So we are going to recognize this interest over 5 years, essentially. Okay, and remember that this is on top of the 60,000 we pay every year. Okay, so we don't change that part of the bond structure. The bond pays 60,000 per year for 5 years. So that's the fact which is printed, okay, on the contract, on the agreement between the company and the bond holders. So let's proceed with the adjustment on December the 31st, because we are going to have two adjustments. One for the payment that we're going to make next year, so for the 60,000 we're going to make, and one for the discount we need to amortize for 3 months, essentially. Okay, so let's start by amortizing the discount. So the discount is 41,002, and it's going to be spread over 5 years. Okay, so we can determine the yearly amount. So the amortization, well, okay, we can leave it in red. Amortization of the discount, straight line amortization, it's going to be equal to 41,002 divided by 5. Okay, so it's going to be 8,200.40. Okay, so we need the 40 cents per year. Okay, that's the amortization. Then we can journalize 8,200 for the sake of simplicity, but it is 8,200 per year. So per year, okay. So on December the 31st, 2020, we need to report the amortization for 3 months. Not just from October to the end of December. Okay, and what is the entry? Well, amortizing means that we decrease this contra liability, so we credit the discount. The full name is discount on bonds payable. Okay, that's the full name. Just to separate this item from other sort of discounts, because the term discount is used very often. Discount on purchases, discount expenses. This is discount on bonds payable. And this is a decrease of the contra liability, right? So it's CL minus. So what happens when a contra liability decreases? Your liability increases. Okay, so this is an adjustment. In the debit side, we report the interest expense. The reason why we have a discount because we pay a higher interest expense. Okay, so we have an additional interest expenses. What is the amount? It's 3 over 12 multiplied by 8,200. Okay, so 312, no, 3 months of discount. 8,200 would be the yearly amortization. So this is 2,050. Right? But remember, this is only the additional expense because it's on top of the payments we make because we promise to pay 60,000 per year. So that also generates an adjustment. Okay, now you could combine this adjustment together. I prefer to keep them separated, to adjust the discount first or after, and then to adjust the for the interest payments we're going to make. Because we need to recognize an interest payable. That is, on December 31st, we also need to recognize that we are going to pay an interest next year. The interest payable is going to be 3 over 12 of 60,000. Remember, 60,000 is the payment we make every year. So what is the portion we need to recognize in the first year? That's 3 months. So it's 15,000. And what is this payable? Well, it is liability, clearly, right? The payable is liability, and it generates an interest expense. This very same interest expense we recognized earlier. It's not another interest expense. Okay, so that eventually the total interest expense report will be 17,050. Okay, you just the sum of those two amounts. And if this bond was issued at face value, the only adjustment you would have needed would be the interest payable by 15,000. Okay. But since this bond was issued at a discount, on top of those 15,000, we also need to calculate the discount, okay, a portion of the discount. Of course, the whole discount is 41,000, that's for 5 years. Okay, what is discount for 3 months? 2,050, and we recognize this portion of interest in 2020. Right? So, what is the carrying amount of the bond at the end of 2020? Now we can report this, right? Because now we have all the information we need. We know what the discount is, and we also calculated an amortization of the discount. Okay, so let's summarize the information we have right now in our balance sheet and also in the income statement. So let's summarize it so we can understand what we report in the financial statements. So new page. And of course, I'm going to upload all of this. Okay, so when I'm finished. So let's start with the balance sheet. Okay, first of all, you have your bond payable here, 1 million. No, yes, 1 million, right? Sorry, no, I was thinking of the other example. And what about the discount? Okay, let's then look at the account. We had 41,002 in the credit side, and we amortized by 2,050. So what is the balance now? So the balance is now 38,000. Sorry, it's the opposite. Forget about it. If the balance is debit, okay, so it's my bad. Then we cancel this. So if I can. Sometimes I cannot. So let's retry it. Okay, so discount started with 41,002 in the debit side. Okay, so then we amortize by 2,050. So the balance will be 38,952, right? The balance sheet at the end of 2020, we report the bond payable by 1 million minus the discount, 38,952. So what is the carrying amount of the bond? Well, the difference. So 961,048 is slightly more than the present value at issuance, because as time passes, the carrying amount increases because the discount decreases. Okay, so that's the first, the second answer we need to provide, which is the carrying amount of the bond payable at the end of 2020. Okay. The income statement, on top of this, we can continue here, okay, below here, there is an interest payable of 15,000. Okay, it's a liability. The income statement shows an interest expense of 17,050, right? Which is the amortization plus the interest payable because of the adjustment we made at the end of December. But this is what you find in the balance sheet. Okay, so the interest payable is not part of the bond. Okay, the discount is. All right. Is it clear? So what is the total interest expense in 2020? That's the question. We already answered this question actually. So the interest expense of 2020 will be shown by the adjustment at the end of the year. Okay, look at this. Interest expense is equal to 2,050 plus 15,000. Okay, what is the interest payment in 2020? Zero. We haven't paid anything. All right, but what is the expense? Well, this is different. The expense is 17,050, so 2,050 plus 15,000. Okay, so you're going to read this amount in the income statement. It's not going to be separate between, payable, discount. You don't get this detail. Okay, all you get is the interest expense, which is 17,050. Okay, which should be equal to 7% of 958,000. So the 7% of your net liabilities. Okay, in financial terms. Although it's an approximation because we just calculate the straight line amortization of the discount. So we can answer this. We can report the total expense. Okay, so total 2020 interest expense is going to be 2,050 plus 15,000. It was 17,050. Okay, so that's the total interest expense for 2020. What is the total interest expense for 2021? It is not difficult to calculate this. It's now that we have all the information we need. In general, what is the interest expense for 1 year instead of 3 months? Okay, this is for 3 months. What is the interest expense for 1 year? It's the payment of 60,000 per year, right? Why? Because 6% or 1 million for 1 year is 60,000 plus the yearly amortization of the discount. Okay, that would be the total interest expense for 1 year. So in 2021, the total interest expense will be 60,000. Which is the 6% of 1 million, okay, plus the amortization of the discount. Okay, so we say that it was 8,200, right? 41,002 divided by 5, so 8,200. Right? Okay, that's the total expense for 1 year, because in 2020, that's the year of issuance, so you only have 3 months of interest. Right, but in the full year, you're going to have 68,200. What is the entry on September the 30th, 2021, when you pay the interest? Okay, so remember the adjustment, we recognized a payable of 15,000. So what happens on September the 30th, 2021? That's the payment date, okay? The yearly payment date. Now, clearly what happens is that we create cash. Okay, when in doubt, start from cash. So we create cash by 60,000, okay, that's a fact. Why? Because it's 6% of 1 million. This is a promise we make. Right? What do we report in the debit side? Well, first of all, we have the interest payable of 15,000. And then we have the interest expense for 2021. Remember, the interest expense is a temporary account. So we close it and then we start from 0 in 2021. Okay, so the interest expense will be 45,000. On top of this, we have the amortization of the discount for 9 months. Right? So I prefer to separate the payable and the amortization. Okay, so I prefer to report 2 different entries. You can combine them in 1 entry if you want. Okay, but for the sake of clarity, I prefer to keep them separated. So on top of this, we need to credit again the discount. And we need to debit again the interest expense. You see why you can combine them together, right? What is the amount this time? Well, it's 9/12 multiplied by 8,200. Remember, 8,200 is for 12 months. Okay. Now we are amortizing the discount from January to September. Okay, no, I can write this right, but this is September. Okay, so that's the amount we report. So it's 6,150. Okay, so on top of those 45,000 we recognize as an expense, we also add another 6,150. And then on December the 31st, 2021, we repeat the very same identical adjustment that we did in 2020. It's identical. Okay, so you can repeat these entries 5 times for 5 years And that those are going to be identical, same amounts, same accounts. Okay. In fact, the adjustment at the end of 2021, I'm going to repeat this just for the sake of clarity. So, and then we can stop, of course. On December 31st, 2021, we had the same adjustments we saw on December 31st of the previous year. So debit, interest expense, credit, discount by 3/12 multiplied by 8,200, and debit interest expense, credit interest payable. By 3/12 times 60,000, which is equal to 15,000. Okay, so I'm just repeating the same just to show you that eventually it is the same adjustment. What is the total interest expense for 2021? Well, we calculated it already. Okay, 60,000 plus 8,200. But you achieve this result in two different steps. Okay, first there is the actual payment of 60,000, and then you have the amortization, the adjustment at the end of December. Is it clear? We can continue tomorrow because I think there are other. No, I think we did it. Okay, we journalized everything. Okay, so we solved this exercise. As you can see, it is complex. Okay, because of different concepts. We continue tomorrow morning with the shareholder section. Yeah.